Is this the beginning of another tariff tantrum? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Kevin Muir, author of the Macro Tourists. Hey, Kevin, it's great to see you again.
Well, it's great to be back with you, Maggie. I'm always enjoying spending some time with you and your listeners.
Oh, great. I'm looking forward to it. Hi, everyone who's joining us live on Substack and on YouTube. And no one knows myself is right out of the gate with a comment that made us both chuckle even before we came on air. Before you start, you have to ask, what beer is Kevin O drinking for this show?
That's right. Well, that's usually my partner, Patrick, is more the drinker. I got to go play squash after this. So unfortunately, I am not drinking a beer.
Okay. I love it, but we'll get a recommendation for him. No one knows myself, just in case you might want to. We'll get one at the end. But it is so fantastic to see you. And, you know, if anyone thought we were going to be off to a little bit of a slow start coming off to a holiday weekend in the U.S., they were wrong, because we had U.S. stocks sell off, yields rising as the Trump administration, Trump himself threatening new tariffs against a host of countries that have so far not reached a deal with the U.S. We had that deadline that was looming, which, by the way, looks like it might have gotten extended as part of this. But a lot of saber rattling again on the trade front. And that seemed to be enough to spark this sell-off. What are you making of this whole tariff situation, Kevin? Is this just kind of an excuse for a very I don't want to say overvalued, but a market that's been on a tear to sort of take a breather? Or is the threat of tariffs in this trade situation something maybe the market's become a little too complacent about?
Well, I think folks kind of are complacent about it. And I think that they're taking it and assuming that this is just a negotiating tactic and we're going to get down. And the reality is that he thinks that tariff is the most beautiful word in the dictionary. He loves it. He is tariff man. And I suspect that when this is all said and done, that he's going to end up somewhere between 15 and 20% across the board tariff for the US. And the real question will be after that point is, like, how does the economy react to it? How does financial markets adjust? And if somebody tells you they know the answer to that, I think you should just ignore them, because the reality is that we haven't had that sort of dramatic change in tariffs in, what is it, 70 years or 80 years? Like, it's been a long, long time. And I don't think that people are appreciating the enormity of the change in the kind of environment that we're experiencing right now.
It's interesting you say that, because I feel like after they walked it back, after the market turmoil and they walked it back, literally people were saying it's over. The trade war's over. Yeah, there'll be noise, but at the end of the day, they're going to reach some kind of deal, because they're just not going to risk the kind of financial instability that we saw following that. And so, like, forget the noise. But you're not so sure about that, it sounds like.
No, I think that he's going to end up somewhere, as I say, between 15 and 20%. And the only thing I will say is that the markets have become comfortable with that. And the reason that they're having trouble today, as we tape this like on Monday afternoon, is that he's instituting tariffs that are higher than what they expect. Like, he's gone and put 25% on South Korea and Japan, two very large trade partners that actually means a lot. So when he moves up from that 15 to 20% that they're kind of expecting, it causes all sorts of ripples and problems. But, Maggie, it's a Monday afternoon in a summer trading. Like most people are at the beach in terms of the liquidity. I don't think you should read too much into this. And I suspect that we're going to get all sorts of tape bombs that we just saw, all summer long. And this is just the new reality under Trump. But I really think that we should put all that aside, because yes, as traders, we need to react to everyone, every squiggle and every kind of headline. But as investors, we need to think about, what does this mean for the economy? What does this mean for the markets over the longer term? And on that perspective, I'm not sure it's good. And I'm not sure that anyone truly knows, because, as I said, we haven't done this in many, many, many decades.
Yeah. Scott Bessent's been underplaying the risks. And we did see some economic data coming, a little bit of a stronger than expected jobs report. People have kind of been looking for things to crater, and we haven't seen it yet. That recession that just never seems to come. Are we is it again a timing thing? They passed the spending bill. It just paid to keep things where they are. I don't know how stimulative it was. It wasn't punitive. They didn't cut a bunch, but they don't have the wiggle room to kind of blow it out on the stimulative side of things. Where do you think the U.S. economy is?
Well, so I actually might disagree and push back a little on that. I think that the big, beautiful bill was actually very stimulative. And part of the reason that folks get confused by it is because when they look at it over a 10-year period, and they look at the amount of debt that they, that the CBOE or whatever it is, well, not the Chicago Board of Options Exchange, but whatever the organization is that measures it, they say, oh, it's only going to add this much deficit. But the thing about it is that that's over 10 years, and they have a lot of clauses in there where the tax cuts disappear after 2, 3, 4 years into the next administration. So when you're looking at the actual effect on the deficit over the next year, it's actually very stimulative. And one of the other problems about it, Maggie, though, is that it's very regressive, meaning that it's really tax cuts for the upper echelon. And I listen, I don't want to just, debate politics and debate whether this is right or wrong. Me as a trader, as an investor, I have to trade the market that's in front of me. So all of that I can look at, though, is look at this thing and say, okay, if we get tax cuts to the upper echelon and they're going to actually have more money in their jeans, probably means that stocks are headed higher. And I think that's what you're seeing here, is that the market is correctly interpreting this big, beautiful bill as, stimulative.
Yeah. Stimulative, at least for assets.
Right. For financial assets. And I'm not as sure about the economics. And this is the problem, is that we're at this, a lot of things are at these stages where any moment it could roll over. Like recently, I was kind of, I was chatting with Peter Berezin from BCA, and he was going through and showing me the beverage curve, which is, the unemployment rate versus the job openings. And when you have a situation where you reach full employment, the job openings just go up and the actual unemployment doesn't go down. One of the reasons that we've had this kind of immaculate recovery as we've tightened rates and as the kind of job openings have, declined, is that we actually had full employment. And so in essence, while the economy slowed, people could still find it easy to find jobs. One of the things that worries me is I looked at this curve, and he had this great chart where he showed how we're at the kink, meaning that as we get less job openings from here, instead of it staying at full employment, we could actually have a situation where unemployment starts to rise. And you referenced recently the better than expected unemployment report, and you're absolutely correct. On a headline basis, it was a better than expected number. But when you dug into it and had a little look at it, you realized the private sector employment was down. And not only that, the beat was actually all the result of state level educational workers, which is most likely the problem with the extremely cold winter and, teachers and stuff staying on a little bit later. So what worries me is that people are the most bullish, the most sure about, the rally continuing and the economy being strong at a point where it's actually there's a lot of risk out there. And that's really what scares me a lot.
Yeah. We have some great comments. Some of them are comments from this very smart community, and some are questions. Let me just talk about this comment, and thank you, Name, for putting it, because I think it's really interesting. I don't think it's all going to fit on the screen, but they say, I work in e-commerce, and tariff price increases are really just starting to go into effect this month. And some of the small businesses relying on imports from China are starting to implode. Remember, everybody pulled all those inventories in, right? When we thought that was a hard and fast deadline, and they've been working off these inventories. To your point, Kevin, we don't know what that impact looks like. It looks like it hasn't had any, which is, I think, what Scott Bessent is referring to, but we don't really know what that means.
And I think that's great that listener is sharing that view. I think that there's a lot of lagged effects that we're going to start to experience that'll be similar to that in terms of tariffs kicking in terms of the bite of the higher interest rates kicking in, and a million different aspects of that. And I continue to be just amazed at how everyone is so bullish here when it seems like there's so much risk in the market. And now I know what the bulls are going to say. They're going to say, listen, you're fighting the tape. It's a losing battle. Stocks just go up and up and up and up. And I'm going to push back to the idea that the market is always so efficient and always understands things so well. And I'd just like to remind everyone back to 2007. And I'm not trying to say that we're about to experience some sort of great financial crisis and that the problems are anywhere near as bad as back then. But I just want to tell this story because I think it illustrates how wrong the markets can be. Back in early 2007, the market started to roll over and there were some hiccups in the real estate market. And Jim Cramer went and had his famous "they know nothing" rant. And he just went on this rant. And if you're interested, go Google it, watch it. And to me, that rant was always, was in my mind, was always towards the end of the decline. It was when everyone was bearish and he had this rant. And I was shocked to go look at the actual date. The time he did that rant where he said that the Fed doesn't understand the problems in the system. The Fed doesn't understand, how much, problems we're going to have in real estate. That was the first 10% correction from the highs. The first, and it was early 2007. And what happened was he did his rant. The market went down another 2%, and then for the next quarter, rallied up to new highs. And it was shocking to me that it was clear now in hindsight that Jim Cramer was spot on correct. And I'm having a little trouble saying that, but he was spot on correct in his analysis about that the Fed was clueless and that the reality was that this was way worse than everyone expected. And yet the market went to new highs. And so I just push back to this theory that the market always knows better. And yes, you need to do proper money management. And there's no doubt that there's a chance that this gets even dumber. Like go back and look at 1998 as a perfect example. Long-term capital happened in the next 6 months. The NASDAQ went up. I can't remember what it was. It was something like 80%. And then the really amazing part is it went sideways for a little bit. And then the final push from late 1999 to early 2000, it was another 110%. So markets can go and do crazy, stupid things, but that doesn't mean that it's a long-term great investment. So one of the things that I just want to remind everyone is, sure, you can trade it, you can get on this bull run, and there's no doubt about it. Have fun, enjoy it. You're making money, but be careful from a longer-term perspective about the kind of thought that there's market isn't full of risk, because I truly believe that there is way more risk in this market than almost anyone believes.
That's so interesting. And there's a reason that we should look back on history, because it can be informative. It doesn't repeat itself, we know,
right.
But there's a lot in there sort of to remind yourself of when you're trying to assess risks. And no one's ringing a bell. And we both lived through those periods, and you didn't get that feeling that things were, you didn't get a notice that said, please be careful now. You're
Right.
lose half of your retirement because things are going to go pear-shaped, right?
Yeah.
That's why we sort of try to put a lot of different opinions on. And again, that time frame, right? We can get a melt up all summer. We can hit new highs in the summer.
For sure.
But if your view is longer, or you need that money in 6 months, a year, this is when you maybe need to be paying attention. Paul said, considering the large portion of consumer spending is by higher income consumers, providing them tax cuts is stimulative in that regard, correct? The old trickle-down, theory.
Listen, there's no doubt about it. And at the very least, it's stimulative for financial asset prices. I will not deny that. And that
what
is
about earnings? What about companies who sell to other people who maybe aren't in that high income bracket?
I'm much less excited about that aspect of it. I suspect that one of these days the earnings are going to roll over, and The real question is, does it make sense to pay 22 times forwards earnings for the S&P 500? And not only that, in an S&P 500 that is increasingly concentrated in terms of this one sector that, the Mag 7 comprised of. And I know people will tell me, oh, no, they're different businesses and different things. And I get into all sorts of debates with people who tell me that this is so much different than the .com, because the reality is that the .com was going up on nothing. And this is actually, these companies are making money, and they tell me all the reasons why this time is different. And I kind of shake my head and I say, listen, in the .com, they had just as important and just as convincing reasons why that time was different. And it always is different. And there's, like you mentioned, Maggie, it's never exactly the same. It doesn't look like exactly the same in terms of this is what goes up. But the reality is that there's an underlying fundamental kind of, it's going up because it's going up, I have to buy it, and a FOMO aspect of it that is driving markets. And to me, I know it. I feel it. My friends feel it. I talk to guys that got bearish during Liberation Day, and they're sitting there and they're talking to me all the time. Like, I don't know how long I can, stand being in cash. And I really think that that's something to think about. Remember, one of the things that I think is interesting about this rally, Maggie, is that it really was the institutions that got bearish. Like, if you go look, Bank of America has got this great chart where they show, like, I think it's in their fund manager survey, where they show the flows, and they break it up into like retail, institutional, and maybe corporate buybacks. And they show the flow of funds. And it was the institutional selling all during the Liberation Day, and retail just stood in there and bought it. Yeah. And it's actually quite shocking how much they stood in there and bought it in terms of that. And now what we're seeing is the retail's even more emboldened, right? They're like, oh my gosh, look at that. You guys were wrong. All you guys got bearish, and they're getting even more emboldened. And whenever I hear people telling me something's like can't lose and that they're winning, and that to me is the ringing of the bell. And it's so difficult because even just saying this right now, I'm talking about this, and the stock market's basically at all-time highs, and everyone that's listening is going, yeah, you know what, you're another worry wart that's worried about the stock market, and the reality is that that's not making you any money. And yes, I agree right now, but I just want to remind people, I haven't been bearish the whole way up. I'm not one of these perma bears. And in fact, I was quite bullish in 2022 and 2023 when everyone was quite bearish, because at the time I really truly did believe in fiscal, and I understood that what that was doing to the economy and the stock market and the power of fiscal. And I thought it was going to overwhelm the monetary effects. But what I find kind of amusing, Maggie, is that I used to go and tell everyone that the government's deficit is the private sector's credit. And the pushback that I got about that was huge. They would tell me all the reasons why it's not going to work and blah, 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 and stuff. And now the folks that were telling me why it wasn't going to work are telling me why I need to buy stocks, because the reality is that the deficit is so large. So therefore corporations, profits are going to be, that much greater. And one of the things that we always need to remember is, what are you paying for it? Back in 2022 and 2023, when everyone was expecting a recession, you weren't paying top dollar for the US stock market. And now you're paying like, a crazy number. And so even if you're right, it's going to be tough to make money. In 2022 and 2023, I remember saying, even if I'm wrong, the fact that everyone's so bearish on the economy, even if we get a recession, I feel like stocks aren't going to go down that much, because the reality is that there was so much bad news priced into them. Yeah. I feel like it's almost the opposite now. We get a situation where even if I'm wrong about the economy rolling over, that it's going to be difficult for stocks to go up because there's so much good news priced into it. And I was watching a video the other day of Steve Cohen, and Steve Cohen's like, yeah, the reality is when you're paying these sorts of prices, you have to be really, really right about the stock market. And I just feel like it's a little bit of musical chairs right now. And I don't see how you can be comfortable paying 22 times forwards earnings in an environment where we have, the potential for the bond market to go no bid and the dollar going down. There's a whole host of reasons, and it just feels very precarious to me.
Yeah, I'm going to ask you about the dollar, but just to comment that, and this is what you're talking about, chasing performance. There are institutional investors under allocated, including international ones, remember, who all moved out of the US. So there's pressure if they're underperforming. So yes, in the short term, they're asking, does it mean there's room to run? Maybe in the short term, but your point is like to pull the lens out a little. And someone on Substack, by the handle someone, by the way, not just someone. I love this name and someone. We're very mysterious today. Our nominal drawbacks, impractical given the math of it all, is it really just a factor of degree of number go up? And it is that a lot of those flows, whether it's retail doubling down or passive, that seem to in the short term be driving, but for all the reasons you just brought up.
Well, can I talk a little bit about the short term in the last little while, because I think that people are misconstruing what occurred during Liberation Day and why we're going up. And I think that one of the things that is increasingly driving markets are the vol control funds, right? So we have the option trading, like from the things like the JP Morgan whale, that quarterly fund that always rolls. And those market makers are definitely affecting the stock market. But at the same time, we have these vol control funds. And I always kind of knew about them, and I saw how they behaved in terms of their exposure going up and down. And I've been following them for a while. I posted them every week in terms of their exposure. And what was interesting about this last Liberation Day event was that we had the initial sharp decline. And the thing about these vol control funds that you need to remember is that they are backward looking. They set their exposure based upon realized, not implied, not forward, but realized volatility. And they actually have two different factors that they use. They use a 30-day and a 90-day historical volatility, and it's the larger of the two. So which means that when you get a spike higher, it immediately degrosses. So we had this situation where in the Liberation Day panic, these volatility funds degrossed and they sold and made it worse than it probably would have otherwise been. But one of the interesting things about it is usually when you get a decline like that, the subsequent rally volatility compresses and we get just a kind of a move higher, a grind higher. Well, we didn't get that, that sort of rise in the post-Liberation Day period. We actually got a very volatile up and down as he took them off, put them back on, took them off, and it was very volatile. So which means that as we rose back up, realized volatility stayed extremely high. So what that meant was that the vol control funds didn't buy back as quickly as they usually do. And then what occurred is in the last month or last few weeks, realized volatility compressed, and it had to do with the fact that it helped that we went up into the point of the option structure where market makers were long a lot of gamma. And when market makers are long a lot of gamma, it actually has the effect of compressing volatility because they're there to sell rips and to buy back on the dips. They actually, instead of exacerbating it when they're short volatility, where they're selling as it goes down and buying it back as it goes up, they're doing the opposite. They're actually selling as it goes up and buying it as it goes back down. So they're compressing volatility. So realized volatility came in, and then the vol control funds started to buy back. And one of the things I recently did this study was because a lot of people go and they say, okay, look at this, the vol control funds based upon the realized volatility that we're experiencing now, will be buying for the next week or the next 2 weeks. And actually I went and with the help of my buddy Manveer, we actually created the model and we actually made it so we could forecast the flows. And one of the things that amazed me about this was that when I did the forecasting of the flows, it was much more elongated than I ever imagined. I suspected that we were almost through the vol control buying. I thought that, okay, we're, market's settling down. They're going to be filled, and it's still there. So when I think about why the market, today was the exception, today was down because of lots of bad news, but on the whole, we've been kind of grinding higher on no news, to
Mm,
me, that's the vol control funds. And one of the things
interesting.
that I've been saying is until they get back up to their regular exposure, I don't think that you can be too bearish. And so when that was one study that helped me kind of just stay out of trouble and say, until we get back to this period where these funds are back to a regular sort of exposure, there's no point because they're just continually buying. And
Mm,
this is one of the things I think, Maggie, in terms of the reality of the current market, and we were saying how it's always different and how it's always evolving. These funds didn't exist before. Like this is completely new, and it's changed the way that the market behaves. And it doesn't mean that the stock market can't go down because it went down today, but
mm.
it just shows you that, like, in absent of any news in the past where it would be neutral, these funds are there buying and it's causing a positive. So there's all sorts of weird flows. So I don't like the flow kind of when people say passive. I
Yeah.
don't know if that's actually as important. Yes, passive is always there and it's always going into the market, but passive isn't changing in terms of its up and downness. It's not turning into a seller one day and then turning into it back into a buyer. And so therefore, I think that the vol control funds are much more important in terms of understanding the kind of the squiggles, if you were the in terms of timing.
No, that's so important. Thank you for bringing that up. And you all can certainly weigh in the comments if that makes sense to you, if you agree with that. But importantly, it means that some of the sort of narratives or the fundamentals that are assigned to market moves may not tell the whole story or any of the story
Yeah.
of what's going on. And I think that sometimes puts retail investors at a disadvantage because maybe they're not looking at all of that. So it's so important to bring things like that to the surface, Kevin. So thank you for that. We have a question from Jim and a few others. What are your thoughts on DXY with new round of tariffs, or just in general, the dollar?
So the dollar. I am a long-term bear on the US dollar. And I went and looked at this piece I wrote when Trump was first elected, and I went through my predictions about what that would mean. And I got some right, I got some wrong. One of them that I got right was that I said the US dollar is going to enter into a secular bear market. And I think it has. I really and for a host of variety of different reasons, but one of them as well that's quite obvious that I don't think enough people talk about is that Trump wants a lower dollar.
Yeah.
Like he doesn't say it outright, but the reality is that he wants to get the trade deficit down. One of the ways you can do it is by getting the US dollar down. It's a way of inflating and helping everything. And yes, does he want the US dollar to be the reserve currency? Of course he does. But just because you continue to be the reserve currency doesn't mean that it's not going to go down in terms of value. So I am a US dollar bear over the long run. So then it becomes a question about timing and the fact that we've already experienced, a 10 or 15% correction. And are we about to get a snapback rally? And all my fast money friends are positioned that way. Like everyone, I just got in a debate with a very smart guy earlier, in terms of what I think the market is positioned for versus what he thinks it's positioned for. And I said, everyone I know that's kind of a trader is scared to death of a snapback rally. And if they have a dollar position, it's to own it. They're all scared of that. And I understand that. I feel the same way. I look at the sentiment is terrible. There's all sorts of bears. It's way down and out. It's bumping up against a trend line. For there's a million reasons why, from a trading perspective, that we're due for a bounce. And I feel like we probably will bounce. But one of the things that I suspect is that in true bear markets, you don't get a chance to sell it as well as you think you're going to sell it, in terms of like in true bull markets, you never get a chance to buy it. And the dips don't end up being as nice and back to trend lines and stuff as you think. And I suspect that the US dollar over the long run will be much, much lower. And that even as we get bounces from what could very well be a level right here, the bounce will be weaker than everyone expects. And the real kind of surprise will be how quickly it rolls back over. So I know that's kind of wishy-washy, and a little part of me worries that the true terrible bear market, it ignores trend lines break, and it just keeps going. And I'm actually, a little part of me is thinking that that's the case, from that perspective. One of the things that I also think that people have over exaggerated is the amount of selling that overseas investors have done in relation to their U.S. assets. And I was recently in London, and it was interesting to go out with clients and traders, and you realize how important what they call their hedge ratio, meaning like how much of their U.S. dollar exposure have they sold for their U.S. asset holding. And let's face it, everyone is long tons and tons of U.S. assets. And one of the interesting things is, if you thought about it from a European perspective, owning Mag 7 was a beautiful trade, in that when Mag 7 was going higher, everything's great because the stock's exploding. And then when it was a risk off event, you had a situation where the US dollar would go up because it's risk off. So when your stocks are doing worse, your dollar's doing better, and when your stocks are doing great, you're happy that the stock's going higher. So it was a little bit like risk parity, Ray Dalio with his Bridgewater, in terms of buying stocks and marrying it with bonds because they were negatively correlated, and therefore you could take more risk because you could always count on the bonds saving you when your risky stocks went down. So it was very much the same way in Europe. And the kind of narrative has been that those guys all sold. And I don't see it. I think that the long-term money, I don't even think they sold any. I was out for dinner, and I was shocked at the amount that said, yeah, the reality is I know I should have sold, but it hasn't paid for the past decade, and it's just made a mess. And so I really, truly believe that the longer-term trend of Europeans, Japanese, Asians selling and hedging their US dollars has just started, and that this trend will be years in the making. And if you look on a purchasing power basis, the US dollar, it got to stupid expensive versus the rest of the world. Very rarely do markets trade at fair value. They go from stupid expensive to stupid cheap. And I think that when you step back and think about it over kind of a year or a decade long, basis, that we are headed lower.
What's the fallout or benefit of that? Like, what's the knee jerk winner and loser if you got a position for something like that? Because you're right, it's kind of against consensus. Not that people think the dollar's going lower, but not the way you described it.
Right.
What's the winner loser?
Well, first of all, it's bad for U.S. financial assets, because part of the reason that U.S. financial assets have done so well is because the U.S. dollar's gone up. Like it's almost the same thing, but it's better for the U.S. economy. Like if you're trying to build tractors in Idaho, you can't do it with the dollar here. And we could sit around and talk about tariffs all we want, but let's face it, the real problem is that the Chinese have, been leaving their currency way too cheap for way too long. Like when the Americans go out and buy iPhones, it should have resulted in, the renminbi going higher. When there was that huge demand, we should have got an adjustment. But instead, what they did was the People's Bank of China, sold them the renminbi, and then they bought the US dollars, and they reinvested that in the US financial system. And so as such, U.S. financial assets have been bid higher than they otherwise should have been. It is the other side of the trade deficit. So one of the problems with Trump in terms of him trying to get the trade deficit down is, if he is successful about getting the trade deficit down, it probably means that stocks and financial assets are lower in their prices. And when I talk to, smart folks about that, they inevitably tell me he doesn't really want to get the trade deficit to zero. Like that's like, they'll be like, okay, Kev, you're right. If the trade deficit goes to zero, stocks will go down, but he doesn't really want that. And I'm unsure. I don't think he knows what he wants exactly. I think he would love for it to all be true. But at the end of the day, I think he's more loyal to the people who elected him than the Wall Street guys. Like, even just take his fighting with Elon. Very quickly, he's just like, giving him the boot. And I think he's more loyal to the MAGA types than the financial types. And so therefore, when you're asking what is the long-term effect of this, I think it's a lower US dollar and a lower US stock market, but a better US economy. And I think that's the problem that a lot of people have. They assume a better US economy will mean higher stocks, and it might not. And that's one of the things I just want to emphasize.
Great way to look at your portfolio to see what you're exposed to. Are you exposed to the financial economy, or are you more exposed to the real economy? I want to squeeze one last question in from Robert on Substack. Wants you to comment on the oil gold ratio.
So I don't like that ratio because I think that they trade differently. So I'm just going to talk about them individually, and then we'll go from there. So from a gold perspective, I have been a gold bull for a long time, and it started in terms of when I got really bullish when Russia invaded Ukraine. And at that point, we had a situation where the West, led by US, zeroed Russia's central bank reserves. And it became very clear to me, I just put myself in the shoes of the People's Bank of China, and I thought to myself, okay, I've just watched them zero these reserves. I, from a fiduciary point of view, have no choice but to go and to invest in other assets. And that's not going to happen overnight. It's not something that they needed to do immediately. But at the margin, I just kept saying People's Bank of China is going to be on the bid for gold for years to come. And I think that that's proven the correct call. And I don't think you need to overthink that. That is going to continue. So for me, gold will continue to have that bid from the central banks of the world. And yes, one of the things that was kind of the gold traders had trouble with over the last 2 years was the fact that it was trading very how should I say that? It wasn't trading as it should in terms of its relationship with the US dollar and the US rates. Meaning that in the past, we had this very tight relationship between US dollars and the US rates, and it actually made a lot of the gold traders bearish on gold. And I kept saying, no, put that away. That doesn't work anymore. Put it away. And so I continue to believe that you should put that away. But having said that, at the margin, if you have a situation where the US dollar is going down and US rates are going down, now all of a sudden the American investors that in the past had been shunning gold will also be competing with the People's Bank of China for gold. So we could have a situation where not only is the People's Bank of China buying it, but also, American investors are buying it because we have US dollar going down and US rates going down. So that's on that perspective. Now, in terms of oil, just from a trading perspective, I don't know anyone that's not bearish. Like nobody. Like I can't tell you the last person that said, stood up and said you should buy oil. And so it really worries me how much people are assuming that oil is in this secular bear market. I really like Paul Sankey. He was always the voice of reason when it comes to oil. And I remember I was chatting with him and I interviewed him once and asked him, I said, what would it take for you to get bullish oil over the long term? And he says, if it ever ends up being that the US shale starts, the supplies start dwindling, then that will be, my cue to get bullish. It seems to me that that's occurring. And this is occurring at the same time when the global economy might be picking up in terms of in the past, we didn't have the rest of the world doing fiscal stimulus. Now, all of a sudden, because of Trump's policies and because of what he's doing, and, I'm a Canadian and I can just look at the Canadian economy, we are going to go from having a 2% deficit to GDP to a 5%. Europe's the same deal. Europe was 2.5. They're going to be 5, in terms of spending on infrastructure and spending on stuff for the war. Japan might be doing the same. So in the past, the US was the only one willing to run deficits and to run their economy hot. Now it seems like the whole world is running their economy hot. And by the way, that's part of the reason that I'm bullish on the rest of the world in terms of their stock markets. And I know there's been a lot of false starts along the way in terms of people getting excited about non-US stocks. But ultimately, I think that this is a case where we are going to have the fiscal stimulus in the rest of the world. And not only that, we're going to have tariffs, and you're going to have things like Japanese are going to say, well, listen, why am I leaving my money in the US paying these crazy high rates? I need we need to take the money back to the Japan. And so when people say, oh, how are you going to buy euro or how are you going to buy yen? They're such terrible currencies. I always say it doesn't matter. All you need is that money going back to home. Because let's not forget, the US is the most overweight from a weighting perspective of clients, out there. And so if everyone just goes back to benchmark, that's going to mean a whole lot of non-US buying throughout the rest of the world. And I think that's what's occurring. And I don't think you should overthink it.
Kevin, fantastic conversation. I love catching up with you. It's been too long, but we covered a lot of topics today. And while we have this time dodging the headlines and the tape bombs, I think it's a really good opportunity for us to all consider some of the things that you just talked about and make sure that our asset allocation reflects how comfortable we are with some of this, because there's a lot going on underneath the hood based on the way you just described it.
Yeah. I'll leave you with one quick story that I love telling in terms of Barton Biggs, that famed strategist.
Yeah.
He was once interviewed and they asked him, they said, Barton, you've been around for a long time and you were there in 1982 when the whole world changed from one of inflation to disinflation. And he said, and they asked him, they said, what was it like? And Barton, with his wry smile, looked at them and said, the trouble about 1982 was you didn't realize it was 1982 until 1985. And I think that that's what we're going to look back and we're going to be like, this past year is one of those watershed, hinge moments in history when the whole macro environment changed. And I just make sure you stay open to different ideas.
I think that's beautifully said. You're absolutely right. And it does feel like we're in one of those moments on so many different fronts. So we have to sort of live at the intersection of a lot of different trends coming together as well. Kevin, thank you so much. We appreciate you.
Oh, my pleasure. Thanks. It's always great to be with you, Maggie.
Have a great rest of the week. Oh, wait, let's answer 2 questions. So if you were going to have a beer tonight, what would it be?
It would be a Moosehead. I got to pick a Canadian. I love it. It's an East Coast beer. When we had, actually, a quick story about Moosehead, when we had our problems, our conflict with you guys in terms of Canadians versus Americans, the Moosehead decided to make a case of beer that was 3,741 beers. And it was basically a beer a day for the entire Trump administration. And I thought to myself, oh, that's a great thing. It's like this entire crate. And so I went onto the website to buy one because I thought, oh, this will be great for our podcast. We'll have a big party. We'll buy these 3,700 beers. We'll invite people and it's sold out in a heartbeat.
Wait, this is a fantastic business idea. If any of you people are in the beverage industry yourselves, there might be a market for that here in the US. I don't know, like either on a celebratory or like a commiserating.
That's right.
Depending on which way,
I couldn't believe it. I was like, oh, I'm sure I'll be able to buy one. And they're like, nope, they're all sold out. So
oh my gosh, that is so fantastic. Okay, we have another funny question, which I think must be a reference from another conversation you were having someplace from Investment Guy on Substack. Kev, choose one. Elizabeth Shue from Cocktail or Leaving Las Vegas? Or do we? Are
that was because this morning, the Scott Besson said something to the effect that there is no chance. No, it wasn't Scott Besson. It was Kevin Hassett. Said there is 0 chance of a recession, and I joked. I said something like, "Oh yes, there's about as much chance of recession as there is of Elizabeth Shue appearing in my DMs asking me out," but that doesn't mean. And then I didn't realize my crew, they're a huge Elizabeth Shue fans. Like I was quite amazed. I was trying to pick somebody age appropriate for myself, and that I had a crush on as when I was younger, and she was a little older than me, and I always thought Elizabeth Shue would be a great pick, and I was shocked. I obviously attract people of the same ilk because she was a big hit in the Substack chat this afternoon.
That's hilarious. Nobody came up with Adventures of Babysitting though. Like,
well,
everyone
because I
went right
think
to
she's a little
Cocktail
young,
and
because
Leaving
there's
Las
also
Vegas.
Karate Kid and stuff like that. But then that's getting a little, you're feeling
It's
a
a little
little
weird. Yeah,
like
it's
that's a little
weird.
weird. So yeah, no, it was definitely either Cocktail or Leaving Las Vegas.
You gotta love conversations when we can like make the way from Dollar and Vol Fund to Elizabeth Shue. Like, it doesn't get any better than this, people. By the way, in the poll, as usual, we have like such a diverse group. Are you bullish or bearish equities for the second half of 2025? And it's dead even, man. 50-50.
Interesting.
Yeah.
Yeah.
Interesting. All right. Well, the chat gave us a lot to think about, Kevin. So we're gonna take that all away. But we love it. Thank you so much for the comments and for the participation. Tommy Thornton was in the chat. Blind Squirrel was in the chat. We love to see you guys here. Thank you so much. Tommy has some thoughts. I bet he's shortened something. So we'll get him on and he can talk about it. He's not afraid to do that. But seriously, thanks to all of you. Listen, it's Monday. Have a fantastic week. And as always, take care and good luck out there.